Hi, today we continue our discussion on investments and we continue our discussion on stocks. This is stocks part 2, equity shares. So the potential partners in a new business venture must create a system to determine who owns what. The simplest concept is that of equity shares in the company, where each share represents a fixed fraction of the company. So if there are 3 original investors, each who contribute $100,000, they can decide to have 3 shares, 1 for each, thus creating an equal partnership of 3 investors. Even though there are 3 investors, choosing 3 shares is arbitrary. They could just as easily have chosen 1,000 shares apiece, which means that each share costs $100. Having more shares makes it easier for the partners to add more funding by selling additional shares to new potential partners. Suppose in this 3,000 share company, needing more capital, they decide to sell 500 additional shares to a person at $100 per share, and thus that person contributes $50,000 capital investment to the company. In this case, the 4th partner will have less of a share in the now 3,500 share company, 1/7, as opposed to the 2/7 ownership for each of the original 3 partners. In this case, all the shareholders are not equal in terms of ownership. Nothing says that the additional shares have to cost the same as the original shares, as the cost is arbitrary in this small company and is determined by the current owners, who will explore the marketplace to see the demand for the shares in their company. So maybe the original partners, feeling that their new business is going well, will want to sell another 5 shares, 1/7 of the company, at $200 apiece. So if they find this buyer, then although this investor pays the same $100,000 as the original 3 partners, his fractional share of the company is less. Or maybe there are no buyers at even $100 per share, but they can sell 1,000 shares at $50 apiece. Although this investor puts up only $50,000, half of what the original partners put up, he would own the same fraction of the company as the original 3, namely a quarter, because each of the 4 investors would own 1,000 shares. So we are now starting to see market forces in situations like this. Market forces refers to supply and demand in the marketplace. Now we have talked about the cost of shares to various investors. We should not confuse this with the value of those shares, because for private companies, in other words, companies with no publicly traded shares or stock, values of shares is obscure without this public trading. The real economic value of the shares of a private company are never really known. The best someone could do is study the company completely to the extent possible, and based on the data gathered, estimate a value for the company and a value of each share in that company. Since information about private companies can be difficult to procure, estimates of the value of a private company and its shares can vary widely and thus be of questionable accuracy. Thus, new equity investors in private businesses must always be very careful. In our next topic, we will discuss companies that go public and offer shares to the general public, and the concept of publicly traded stock is introduced. Thank you very much.